Scott is calling from Cambridge, Ontario. Go ahead, Scott.
Oh, good evening. My question is for David on TD Bank. TD announced that they're going to have a $400 million write-down on the American side of their assets, and I'm just trying to find out if there has been a consensus for the first quarter on TD, and I don't think the $400 million was factored in for the consensus that has been given on the street. And in your opinion, would you see that first quarter TD would have a miss and on the earnings per share? And if so, J.P. Morgan, they had their earnings and looked like the street gave it about $2 up after their write-down. So I'm just trying to compare and to see on what I need to be doing for myself on this. Thank you so much. Sure. I'll hang up.
So these provisions are always hard ones to read, aren't they? Companies do these big write-downs or gains, and it often doesn't seem to move the stock.
Right. So remember that you want to look at why these things are taking place in the U.S. Companies like J.P. Morgan, Goldman Sachs took big write-downs because of the changes in the way that they're being taxed. The net is that the U.S. banks are the sector that benefit most from the tax cuts. They pay a lot of tax. Their tax rates are going to go down a lot. In order to be able to take advantage of that, there's some short-term house cleaning that these banks are having to do. And the market looks at that and says, look, that's a one-time item. These tax cuts go on for a really long time. So as a result, companies like Goldman Sachs and J.P. Morgan had literally no impact from these write-downs. Mm-hmm. And I would expect it to be the same for TD. In fact, it's interesting. If I were to pick a Canadian bank, I'd pick TD because of their very significant U.S. exposure. Their business is going very well in the U.S. And in fact, there are some that believe that actually the tax changes might be very significant for TD Bank. And I think they are not factored into the numbers at this point. So I think that going forward, there could be a pretty good surprise as far as the impact on the tax changes in TD Bank.
So you think, it sounds like you think if you're a holder of TD Bank, hang on to it.
Yeah, I'd buy the stock here. And in fact, we seriously considered using it today as a top pick, partly for that reason and partly because of their exposure to the U.S. economy.
Justin Mulligan, I see you were asking about the stock on Twitter. I hope that answers your question as well. Dorothy in Mount Hope, go ahead, please.
Yes, my question is on Brookfield Asset Management. I have a significant holding in Brookfield, and in the last month it's had about an 8% pullback. It had a nice gain today, but I'm just wondering where you see the stock going, if I should sell a partial holding or sell them all and put my money into a different sector. Right. I wonder if you could comment on this. Thank you.
Thank you.
So Dorothy, I hope you've been a holder for a long time. It's been a great stock. What you're buying when you're buying Brookfield Asset Management is a lot of very long life assets, a lot of infrastructure, a lot of real estate, which are things that benefit when interest rates are falling. A lot of institutions gave money to Brookfield to invest in long life assets as an alternative to owning bonds, something that was quite predictable. Now, if you look at the sectors that act like bonds, utilities, telcos, REITs, they have been underperforming over the last couple or 3 months. Actually, first of all, we're underperforming and now absolutely have been pulling back in price as U.S. bond yields go higher. Yeah. And I think that that's likely to continue. So while I think they have wonderful assets and it's a great business, I do think you might consider peeling some off and owning something that is more tied to reflation of assets, shorter duration assets. And we'll talk about a couple today, but you can certainly still buy a predictable asset, but one that might be a little bit better in a reflationary world.
Okay, Dorothy, thanks very much indeed for that question. Darrell is standing by in Winnipeg. Go ahead, please.
You touched on it briefly in the opening comments about the relationship between the Canadian and U.S. dollar. I'm 100% invested outside of Canada, and it's all in the U.S. because of the diversity of their industries. Bearing in mind I don't need to pull those dollars back into Canada for another 5 years, where do you see in the mid and long term relationship? And do you think the volatility will continue, or will it level off at some level at, maybe 80 cents, for example? Thank you.
Right. So, Daryl, let me talk sort of the big picture first. You think about what the big drivers are for Canadian dollars. Certainly energy price is one, which has been rallying over the last about 6-7 months. You look at economic activity, which our Canadian economic data, frankly, has surprised me, given the strength in the employment market and so on. And of course, the other thing is what our counterpart, the U.S. dollar, is doing. And U.S. dollar has been weakening versus world currencies. So we're in what I believe is the third year of a 3-year strong cyclical rally in stocks. I think we have probably 12 months in front of us of strength.
A 3-year cyclical rally in stocks?
Right, so we had our last correction culminated in February of 16.
Okay, yeah.
So we're really 2 years in
okay.
to what I think is likely 3 very strong years. And it's being driven by an improving global economy. So given that where we are in that cycle, you tend to expect cyclical stocks, things that are tied to the economy, to outperform at this point. And we have a lot of cyclical stocks in the Canadian market. So I think that when I look at all of the pieces put together, economic data continues to look good, materials prices look strong, global growth is resurgent, and so that's creating demand for Canadian products. I think the Canadian dollar can continue to firm up here. Now, it is like a cyclical stock. It has its ups and downs, and I think that ultimately, when we do see a slowdown down the road, Canadian dollar can back up. So in the near term, I do think the Canadian dollar continues to firm up. I don't think it's a rocket ship. But I do think that you have to expect it goes a little bit higher. We try to hedge that in the funds that we run. You have to take that into account.
We'll be back with David Burrows. David is answering your questions on North American large caps toll free. 1-855-326-6266.